So welcome to lecture number 7 of STAT 761. And what we're going to do today is finish chapter 5 and then go through some exercises and their solutions. So we begin with section 5.14 of chapter 5. So I'm going to share the screen. So the topic of conversation there is basically, give me 1 second, futures prices and expected future spot prices. So we refer to the market's average opinion about what the spot price of an asset will be at a certain future time as the expected spot price of the asset at that time. Suppose that it is now June and the September futures price of corn is 450 cents. It is interesting to ask what the expected spot price of corn in September is. Is it less than 450 cents, greater than 450 cents, or exactly equal to 450 cents? So the futures price, we have already seen that the futures price converges to the spot price at maturity. If the expected spot price is less than 450 cents, the market must be expecting the September futures price to decline, so that traders with short positions gain and traders with long positions lose. If the expected spot price is greater than 450 cents, the reverse must be true. The market must be expecting the September futures price to increase, so that traders with long positions gain while those with short positions lose. So economists John Maynard Keynes and John Hicks argued that if hedgers tend to hold short positions and when speculators tend to hold long positions, then the futures price of an asset will be below the expected spot price. This is because speculators require compensation for the risks they are bearing. They will trade only if they can expect to make money on average. Hedgers will lose money on average, but they are likely to be prepared to accept this because the futures contract reduces their risk. If hedgers tend to hold long positions while speculators hold short positions, Keynes and Hicks argued that the futures price will be above the expected spot price for a similar reason. So, okay, we understand that. Now, risk and return. So the modern approach to explaining the relationship between futures price and expected spot prices is based on the relationship between risk and expected return in the economy. In general, the higher the risk of an investment, the higher the expected return demanded by the investor. The capital asset pricing model, which we already went through, shows that there are two types of risks in the economy: systematic and non-systematic. The non-systematic risk should not be important to an investor. It can be almost completely eliminated by holding a well-diversified portfolio. An investor should not therefore require a higher expected return for bearing non-systematic risk. Systematic risk, in contrast, cannot be diversified away. It arises from a correlation between returns from the investment and returns from the whole stock market. An investor generally requires a higher expected return than the risk-free interest rate for bearing positive amounts of systematic risk. Also, an investor is prepared to accept a lower expected return than the risk-free interest rate when the systematic risk in an investment is negative. The risk in a futures position. So let us consider a speculator who takes a long position in a futures contract that lasts 40 years in the hope that the spot price of the asset will be above the futures price at the end of the life of the futures contract. We ignore daily settlement and assume that the futures contract can be treated as a forward contract. We suppose that the speculator puts the present value of the futures price into a risk-free investment while simultaneously taking a long futures position. The proceeds of the risk-free investment are used to buy the asset on the delivery date. The asset is then immediately sold for its market price. The cash flows to the speculator are as follows. Today, minus F0 e to the minus RT, so at present value, discounted to today, so minus F0 e to minus RT. And at the end of the future contract, you get plus ST, okay? Because the asset is at that time immediately sold to its for its market price. So F0 is the futures price today. ST is the price of the asset at time T at the end of the futures contract. And R is the risk-free return on funds invested for time T. How do you value this investment? The discount rate we should use for the expected cash flow at time T equals an investor's required return on the investment. Suppose that K is an investor's required return for this investment, then the present value of this investment is minus F0 e to the minus RT plus expected value of ST e to the minus KT, where E denotes the expected value. We can assume that all investment in securities markets are priced so that they have zero net present value. This means that minus F0 e to the minus RT plus expected value of ST to the minus KT will equal zero. So K is the return from the asset, expected return K from the asset. Or F0, if you regroup this equation, is equal to expected ST e to the R minus KT. As we have just discussed, the returns investors require on an investment, as we have discussed, the returns investors require on an investment depend on its systematic risk. The investment we have been considering is in essence an investment in the asset underlying the futures contract. If the returns from these assets are uncorrelated with the stock market, the correct discount rate to use is the risk-free rate, so we should set K equal to R in equation 5.20, which gives F0 is equal to the expected ST. This shows that the future price is an unbiased estimate of the expected future spot price when the return from the underlying asset is uncorrelated with the stock market. If the return from the asset is positively correlated with the stock market, then K is greater than R, and equation 5.20 leads to F0 being less than the expected ST. This shows that when the asset underlying the futures contract has positive systematic risk, we should expect the futures price to understate the expected future spot price. An example of an asset that has positive systematic risk is a stock index. The expected return of investors on the stocks underlying an index is generally more than the risk-free rate. The dividends provide a return of Q. The expected increase in the index must therefore be more than R minus Q. And so equation 5.8 is consistent with the prediction that the futures price understates the expected future stock price for a stock index. So if we go to equation 5.8, there it is. F0 is equal to S0 e to the R minus Q times T. So is consistent, so that equation is consistent with the prediction that the futures price understates the expected future stock price for a stock index. If the return from the asset is negatively correlated with the stock market, K less than R, And equation 5.20, this equation over here, gives that F0 is greater than the expected value of ST. This shows that when the asset underlying the futures contract has negative systematic risk, we should expect the futures price to overstate the expected future spot price. So so here we have basically a summary of this relationship. As we can see, this is the relationship between future price and expected future spot price. So this is the underlying asset. So no systematic risk, positive systematic risk and negative systematic risk. So no systematic risk implies that the relationship of expected return K from the asset to the risk-free rate means K is equal to R. And the relationship of futures price F to the expected future spot price expected values D is that they are equal when K is equal to R. This is basically an application of equation 5.20 over here. We have positive systematic risk if K is greater than R, and then F0 is actually less than the expected value of ST. And we have negative systematic risk when K is less than R, and so then we have F0 being greater than the expected value of ST. So when the futures price is below the expected future spot price, so when the futures price is below the expected future spot prices, which is actually this situation over here, F0 less than the expected value of ST. The situation is known as normal backwardation. And when the futures price is above the expected future spot price, which is this situation over here, then the situation is known as contango. However, it should be noted that sometimes these terms are used to refer to whether the futures price is below or above the current spot price, rather than the expected future spot price. Okay, so that's basically, we can go to the slides and go through the highlights. So we see, so suppose K is the expected return required by investors in an asset, we can invest F0 to the minus RT at the risk-free rate and enter into a long futures contract to create a cash inflow of ST at maturity. This shows that F0 e to the minus RT times e to the KT should equal the expected value of ST, or F0 should equal the expected value of ST e to the R minus KT. So if you want no systematic risk, then K should equal R and F0 should equal the expected ST. If you want positive systematic risk, then you basically have K greater than R and you have F0 less than the expected value of ST. And with negative systematic risk, you have K less than R and F0 is greater than the expected value of ST. So for positive systematic risk, we see that stock indices have that. Negative systematic risk are basically gold. Gold has negative systematic risk, at least for some periods. So that's it. So let's stop sharing. And we are now gonna go to the exercises. So now, yes. Let's go to okay. So now we go to the solutions. So we begin by doing so give me one moment. Resume recording over here. So I'm going to share the screen. So we're going to go through the practice questions, the first 10 questions in each chapter that we covered. So we begin here with the practice questions in chapter 1. So the question is, what is the difference between a long forward position and a short forward position? So when a trader enters into a long forward contract, she is agreeing to buy the underlying asset for a certain price at a certain time in the future. So when a trader enters into a short forward contract, she's agreeing to sell the underlying asset for a certain price at a certain time in the future. So the next question is, explain carefully the difference between hedging, speculation, and arbitrage. So a trader is hedging when she has an exposure to the price of an asset and takes a position in a derivative to offset the exposure. In a speculation, the trader has no exposure to offset. She's betting on the future movements in the price of the asset. Arbitrage involves taking a position in 2 or more different markets to lock in a profit. So then problem 1.3, what is the difference between entering into a long forward contract when the forward price is $50 and taking a long position in a call option with a strike price of $50? Well, so the difference is that in the first case, the trader is obligated to buy the asset for $50. The trader does not have a choice. In the second case, the trader has an option to buy the asset for $50. The trader does not have to exercise the option. So in the next problem, explain carefully the difference between selling a call option and buying a put option. Selling a call option involves giving someone else the right to buy an asset from you. It gives you a payoff of minus the max of ST minus K and 0, which is the mean of K minus T and 0. Buying a put option involves buying an option from someone else. It gives a payoff of max of K minus ST and 0. In both cases, the potential payoff is K minus ST, but when you write the call option, the payoff is negative or 0. This is because the counterparty chooses whether to exercise. Whereas when you buy a put option, the payoff is 0 or positive. This is because you choose whether to exercise. So problem 1.5, an investor enters into a short forward contract to sell 100,000 British pounds for US dollars at an exchange rate of 1.5 US dollars per pound. How much does the investor gain or lose if the exchange rate at the end of the contract is A, 1.49 and B, 1.52? So A, the investor is obligated to sell pounds for 1.5 when they're worth 1.49. So the gain is 1.5 minus 1.49 times 100,000, which is $1,000. In the case B, the investor is obligated to sell the pounds for 1.5 in the market when they're actually worth 1.52. So the loss is 1.52 minus 1.5 times 100,000, which is $2,000. So problem 1.6, a trader enters into a short cotton futures contract when the futures price is 50 cents per pound. The contract is for the delivery of 50,000 pounds. How much does the trader gain or lose if the cotton price at the end of the contract is 48.20 cents per pound and 51.30 cents per pound? So the trader sells for 50 cents per pound something that is worth 48.20 cents per pound. So the gain is the difference, 0.5 minus 0.48 times 50,000, which is $900. In the second case, the trader sells for 50 cents per pound something that is worth 51.30 cents per pound. So the loss is 51.30 minus 0.5 times 50,000, 0.5130 minus 0.5 times 50,000, which is $650 times, yeah. Problem 1.7. So suppose that you write a put contract with a strike price of $40 and an expiration date in 3 months. The current stock price is $41 and the contract is on 100 shares. What have you committed yourself to? And how much could you gain or lose? You have sold the put option. You have agreed to buy 100 shares for $40 per share if the party on the other side of the contract chooses to exercise the right to sell for this price. The option will be exercised only when the price of stock is below $40. Suppose, for example, that the option is exercised when the price is $30. You have to buy at $40 shares that are worth $30. You lose $10 per share or $1,000 in total. If the option is exercised when the price is $20, you lose $20 per share or $2,000 in total. The worst that can happen is that the price of the stock declines to almost zero during the 3-month period. This highly unlikely event would cost you $4,000. In return for the possible future losses, you receive the price of the option from the purchaser. So, exactly. So you sold this option for some money. That's what you receive, the price of the option from the purchaser. So what is the difference between the over-the-counter market and the exchange-traded market? Okay. What are the bid and offer quotes of a market maker in the over-the-counter or exchange-traded market? The over-the-counter market is a network of financial institutions, fund managers, and corporate treasurers who trade directly with each other. An exchange-traded market is a market organized by an exchange where the contracts that can be traded have been defined by the exchange. When a market maker quotes a bid and an offer, the bid is the price at which the market maker is prepared to buy, and the offer is the price at which the market maker is prepared to sell. You would like to speculate on a rise in the price of a certain stock. The current stock price is $29, and the 3-month call with a strike of $30 costs $2.90. You have 5,800 to invest. Identify 2 alternative strategies, one involving an investment in the stock and the other involving an investment in the option. What are the potential gains and losses from each? So one strategy would be to buy the 200 shares. Another would be to buy 2,000 options. If the share price does well, the second strategy will give rise to greater gains. For example, if the share price goes up to $40, you gain 2,000 times 40 minus 30, minus 5,800, which is 14,200 from the second strategy, and only 200 times the difference in the price, which is 40 minus $29, which is 2,200 from the first strategy. However, if the share price does badly, the second strategy gives greater losses. So for example, if the share price goes down to $25, the first strategy leads to a loss of 200 times 29 minus 25, which is only $800, whereas the second strategy leads to the loss of the whole $5,800, which you invested at the beginning. This example shows that options contain built-in leverage. Suppose you own 5,000 shares that are worth $25 each. How can put options be used to provide you with insurance against the decline in the value of your holding over the next 4 months? You could buy 50 put option contracts, each on 100 shares, with a strike price of $25 and an expiration date in 4 months. If at the end of the 4 months, the stock price proves to be less than 25, you can exercise the options and sell the shares for $25 each. So that's how it goes for chapter 1. Now we can go to chapter 2. So chapter 2. So the practice questions, the first distinguish between the terms of open interest and trading volume. Well, so the open interest of a futures contract at a particular time is the total number of long positions outstanding, which is equivalently the same as the total number of short positions outstanding. The trading volume during a certain period of time is the number of contracts traded during this period. So what is the difference between a local and a futures commission merchant? A futures commission merchant trades on behalf of a client and charges a commission. A local trades on his or on her own behalf. Suppose that you enter into a short futures contract to sell July silver for $17.20 per ounce. The size of the contract is 5,000 ounces. The initial margin is $4,000 and the maintenance margin is $3,000. What change in the futures price will lead to a margin call? What happens if you do not meet the margin call? There will be a margin call when 1,000 has been lost from the margin account. This will occur when the price of silver increases by 1,000 over 5,000, which is 20 cents. The price of silver must therefore rise to $17.40 per ounce for there to be a margin call. If the margin call is not met, then your broker closes out your position. So suppose that in September of 2018, a company takes a long position in a contract on May 2019 crude oil futures. It closes out its position in March of 2019. The futures price per barrel is $48.30 when it enters into the contract, and $50.50 when it closes out its position, and $49.10 at the end of December 2018. One contract is for the delivery of 1,000 barrels, and the question is, what is the company's total profit? When is it realized? How is it taxed if it is A, a hedger, and B, a speculator? So assume that the company has a December 31st year end. Then the total profit is $50.50 minus $48.30, which is times 1,000, which is 2,200. Of this, $49.10 minus $48.30 times 1,000, or 800, is realized on a day-by-day basis between September 2018 and December 31st, 2018. A further $50.50 minus $49.10 times 1,000, which is 1,400, is realized on a day-by-day basis between January 1st and March 2019. A hedger would be taxed on the whole profit of 2,200 in 2019 A speculator would be taxed on $800 in 2018 and $1,400 in 2019. So, okay, another problem which says, so what does a stop order to sell at $2 mean? When might it be used? What does a limit order to sell at $2 mean? And when might it be used? So a stop order to sell at $2 is an order to sell at the best available price once a price of $2 or less is reached. It could be used to limit the losses from an existing long position. A limit order to sell at $2 is an order to sell at the price of $2 or more. It could be used to instruct a broker that a short position should be taken, providing it can be done at a price at least as favorable as $2. So, problem 2.6, what is the difference between the operation of the margin accounts administered by a clearinghouse and those administered by a broker? The margin account administered by the clearinghouse is marked to market daily, and the clearinghouse member is required to bring the account back up to the prescribed level daily. The margin account administered by the broker is also marked to market daily. However, the account does not have to be brought up to the initial margin level on a daily basis. It has to be brought up to the initial margin level when the balance in the account falls below the maintenance margin level. The maintenance margin is usually about 75% of the initial margin. So what differences exist in the way prices are quoted in the foreign exchange futures market, the foreign exchange spot market, and the foreign exchange forward market? So in futures markets, prices are quoted as the number of US dollars per unit of foreign currency. The spot and forward rates are quoted in this way for the British pound, the euro, the Australian dollar, and the New Zealand dollar. For other major currencies, spot and forward rates are quoted as the number of units of foreign currency per US dollar. So problem 2.8, the party with a short position in a futures contract sometimes has options as to the precise asset that will be delivered, where delivery will take place, when delivery will take place, and so on. Do these options increase or decrease the futures price? Explain your reasoning. So these options make the contract less attractive to the party with the long position and more attractive to the party with the short position, and they therefore tend to reduce the futures price. The question is, what are the most important aspects of the design of a new futures contract? The most important aspects of the design of a new futures contract are the specification of the underlying asset, the size of the contract, the delivery arrangements, and the delivery months. And problem 2.10, explain how margin accounts protect futures traders against the possibility of default. Margin is money deposited by a trader with his or her broker. It acts as a guarantee that the trader can cover any losses on the futures contract. The balance in the margin account is adjusted daily to reflect gains and losses on the futures contract. If losses lead to the balance in the margin account falling below a certain level, the trader is required to deposit a further margin. This system makes it unlikely that the trader will default. A similar system of margin accounts makes it unlikely that the trader's broker will default on the contract it has with the clearinghouse member, and unlikely that the clearinghouse member will default with the clearinghouse. So let's stop sharing this and we go to chapter 3. Okay. So now, so the question here is, under what circumstances are a short hedge and a long hedge appropriate? So a short hedge is appropriate when a company owns an asset and expects to sell that asset in the future. It can also be used when the company does not currently own the asset, but expects to do so at some time in the future. A long hedge is appropriate when a company knows it will have to purchase an asset in the future. It can also be used to offset the risk from an existing short position. So, explain what is meant by basis risk when futures contracts are used for hedging. So basis risk arises from the hedger's uncertainty as to the difference between the spot price and the futures price at the expiration of the hedge. Explain what is meant by a perfect hedge. Does a perfect hedge always lead to a better outcome than an imperfect hedge? Explain the answer. So a perfect hedge is one that completely eliminates the hedger's risk. A perfect hedge does not always lead to a better outcome than an imperfect hedge. It just leads to a more certain outcome. Consider a company that hedges its exposure to the price of an asset. Suppose that the asset's price movements prove to be favorable to the company. Then a perfect hedge totally neutralizes the company's gain from these favorable price movements. The imperfect hedge, which only partially neutralizes the gains, might well give a better outcome. So, next problem. Under what circumstances does a minimum variance hedge portfolio lead to no hedging at all? Well, so a minimum variance hedge portfolio leads to no hedging at all when rho, when the coefficient of correlation between the futures price changes and changes in the price of the asset being hedged is 0. Give 3 reasons why the treasurer of a company might not hedge the company's exposure to a particular risk. If the company's competitors are not hedging, the treasurer might feel that the company will experience less risk if it does not hedge. Okay, so we saw that with the gold, the jewelers case. The company that was hedging actually ended up having more risk than the companies that were not hedging. So that's table 3.1. Then the second reason is that the shareholders might not want, well, we can actually go to table 3.1 and just remember what we saw there. Okay. Let's see. So, so chapter 3. Share the screen. And we go to table 3.1. So here we have table 3.1. So we have this situation. So we have a change in the gold price and there is an increase. The effect on price of gold jewelry is increase. And then the effects on the profits of the Take a Chance company are known, the one that hasn't hedged. And then the effects on the profits which has hedged actually ends up being an increase. And table 3.1, if you have a decrease in the price of the jewelry, the effect on the price of the gold jewelry is to decrease. The change in the price, the gold decreases, the effect on the price of the gold jewelry decreases. The effect on profits of the company that didn't hedge is known, whereas the effect on the profits of the safe and sure company is that it decreases. So that's basically the example from your chapter 3 of John Hall's book. Okay, so let's go back. Okay, and now share the screen. So we're here. So if the company's competitors are not hedging, the treasurer might feel that the company will experience less risk if it does not hedge. So that's one reason not to hedge. The other is the shareholders might not want the company to hedge because the risks are hedged within their portfolios. The third reason is that if there is a loss on the hedge and the gain from the company's exposure to the underlying asset, the treasurer might feel that he or she will have difficulty justifying the hedging to other executives within the organization. So the next problem is, suppose that the standard deviation of quarterly changes in the prices of a commodity is $0.65. The standard deviation of quarterly changes in the futures price on the commodity is $0.81. And the coefficient of correlation between the two changes is 0.8. What is the optimal hedge ratio for a 3-month contract, and what does it mean? The optimal hedge ratio is 0.8 times 0.65 over 0.81, which is 0.642. This means that the size of the futures position should be 64.2% of the size of the company's exposure in a 3-month hedge. Okay. A company has a $20 million portfolio with a beta of 1.2. It would like to use futures contracts on a stock index to hedge its risk. The index futures is currently standing at 1,080, and each contract is for delivery of $250 times the index. What is the hedge that minimizes the risk? What should the company do if it wants to reduce the beta of the portfolio? The formula for the number of contracts that should be shorted gives 1.2 times 20 million divided by 1,080 times 250, which is 88.9. Rounding to the nearest whole number is 89 contracts that should be sorted. To reduce the beta to 0.6, half of this position or a short position in 44 contracts is required. If the corn futures contract, the following delivery months are available, March, May, July, September, and December, state the contract that should be used for hedging when the expiration of the hedge is June, July, and January. So a good rule of thumb is to choose a futures contract that has a delivery month as close as possible, but later than the month containing the expiration of the hedge. The contracts that should be used then, so if you have here, if you have expiry on in June, then you should use July, which is over here, the next one over, okay? If you have a delivery in July, then you should use September. And if you have delivery, the expiration of the hedge is in January, then you should use March, the month that comes after January for which there is a delivery. Okay, and so March. Does a perfect hedge always succeed in locking in the current spot price of an asset for a future transaction? And the answer is, of course, no. Consider, for example, the use of a forward contract to hedge a known cash inflow in a foreign currency. The forward contract locks in the forward exchange rate, which is in general different from the spot exchange rate. Okay. Explain why a short hedger's position improves when the basis strengthens unexpectedly and worsens when the basis weakens unexpectedly. The basis is the amount by which the spot price exceeds the futures price. A short hedger is long the asset and short the futures contract. So the value of his or her position improves as the basis increases. Similarly, it worsens as the basis decreases. So let's stop sharing this screen and let's go to chapter 4. Okay, share the screen. So here we're asking, so we have in problem 4.1, a bank quotes you an interest rate of 7% per annum with quarterly compounding. The question is, what is the equivalent rate with continuous compounding and with annual compounding? So the rate with continuous compounding is 4 log 1 plus 0.07 over 4, which is this. And the rate with annual compounding would be 1 plus 0.07 over 4 minus 1, which is 0.0719, which is 7.19 per annum. So explain how LIBOR is determined. So LIBOR is the London Interbank Offered Rate. It is calculated daily from borrowing rates estimated by a panel of banks. Okay. Now the 6-month and 1-year zero rates are both 5% per annum. For a bond that has a life of 18 months and pays a coupon of 4% per annum with semi-annual payments and one having just been made, the yield is 5.2% per annum. What is the bond's price? What is the 18-month zero rate? All rates are quoted with semi-annual compounding. So you see, suppose that the bond has a face value of $100. Its price is obtained by discounting the cash flows at 5.2%. And the price is basically 2 divided by 1.026 plus 2 times 1.026. This is half of 5.2%, as you can see. So because we have semi-annual payments, okay, so the yield is 5.2% per annum. So you take the yield, you divide by 2, and you take the present value of 2. So this is 2 over 1.026. This is the present value of the first $2. And this is, and then the second $2, which are paid in 1 year from now. So you discount that, you take the present value of that. So 2 divided by 1.026 squared gives you the present value of that. And then finally, there is the face value plus the coupon, which is 102, and that you discount to the present. So that's discounting by at 1.026 cube, and that gives you $98.29. If the 18-month zero rate is R, then whatever R is, it has to be, if you discount 2 by 1.025, because that's the 6 month. See, this is the 6 month, 5% per annum, 1.025, and you discount the year payment of $2 by 1.0 by this amount by 5% per annum semi-annually. So that's 1.025 square. Then you have to take 102 discount by the 18-month zero rate R. So that's 1 plus R over 2 cubed. That should give you equal to the price of the bond, which is 98.29. And this gives R equal to 5.204%. So problem 4.4. An investor receives 1,100 in 1 year in return for an investment of 1,000 now. Calculate the percentage return per annum with annual compounding, with semi-annual compounding, and with monthly compounding, and with continuous compounding. So with annual compounding, the return is 10% per annum, okay, because it's 10% higher. 1,100 is 10% higher than 1,000. With semi-annual compounding, the return is R, where 1,000 times 1 plus R over 2 squared gives you 1,100. So then 1 plus R over 2 gives you the square root of 1.1, which is 1.0488. So R is 9.76% per annum. So with monthly compounding, the return is R, where 1,001 plus R over 12 to the 12 gives you 1,100, and you solve for R, and you obtain 9.57% per annum. With continuous compounding, the return is R, where 1,000 e to the R should equal 1,100. And so that gives you the logarithm of 1.1, which is 0.0953. So the percentage return is therefore 9.53% per annum. So here you have, this is problem 4.5. And you suppose that zero interest rates with continuous compounding are as follows. Maturity 3, the rate is 3%. Maturity 6 months, the rate is 3.2%. The question is, can you calculate the forward interest rates for the second, third, fourth, fifth, and sixth quarters? So let's say to get the first one, what do? You say e to the 3.0 times 1 quarter times e to the whatever the forward rate in the second quarter is, right? Times 1 quarter should equal e to the 3.2 times 1/2, a quarter plus a quarter. Okay, and so that basically gives you 3.4%. And you do the exact same thing for all the other rates by using, so you will use, so in order to find this rate over here, 3.8% for the third quarter, you will use this rate, 3.2 and 3.4, and you will have e to the 3.2 times a quarter times e to the forward rate times in 1 quarter should equal e to the 3.4 times 1/2. And so that should give you basically 3.8% and so on. So the question is here, assuming that risk-free rates are as in problem 4.5, the question is, what is the value of a forward rate agreement where the holder will pay LIBOR and receive 4.5% quarterly compounded for a 3-month period starting in 1 year on a principal of $1 million? The forward LIBOR rate for the 3-month period is 5% quarterly compounded. Okay, so So then basically you get the value of the FRA is going to be 1 million times 0.25 times 0.045 minus 0.05. So the difference between the 4.5% and the LIBOR, and you are discounting that by to find its present value by 3.6%, which is over here. It's the 15-month zero rate. So you discount that by e to the minus 0.036 times 1.25, and you obtain minus 1,195. So the term structure of interest rates is upward sloping. And put the following in order of magnitude. So you have the 5-year zero rate, the yield on a 5-year coupon-bearing bond, and the forward rate corresponding to the period between 4.75 and 5 years in the future. So what is the answer to the question? Basically, if it's an upward sloping term structure of interest rates, then you will have that the forward rate corresponding to the period between 4.75 and 5 years in the future is definitely above the 5-year zero rate, which is then also above the yield on a 5-year coupon-bearing bond. So when it is downward sloping, then you will have the yield on a 5-year coupon-bearing bond will be the biggest. The 5-year zero rate will be smaller than that. And then the forward rate corresponding to the period 4.75 and 5 years in the future will be smaller than the 5-year zero rate. So what does duration tell you about the sensitivity of a bond portfolio to interest rates? What are the limitations of the duration measure? So duration provides information about the effect of a small parallel shift in the yield curve on the value of a bond portfolio. So the percentage decrease in the value of the portfolio equals the duration of the portfolio multiplied by the amount by which interest rates are increased in the small parallel shift. The duration measure has the following limitation. It applies only to parallel shifts in the yield curve that are small. What rate of interest with continuous compounding is equivalent to 8% per annum with monthly compounding? Well, the rate of interest will be will satisfy e to the r equal to 1 plus 0.08 over 12 to the 12. And so that gives you R 7.97% per annum. And finally, a deposit account pays 4% per annum with continuous compounding, but interest is actually paid quarterly. How much interest will be paid each quarter on a $10,000 deposit? The equivalent rate of interest with quarterly compounding is R, where e to the 0.04 will be 1 plus r over 4 to the 4th. And so when you solve for r, that's 4.02%. The amount of interest paid each quarter is therefore 10,000 times 0.0402 over 4, which is 100.50. So explain what happens when an investor shorts a certain share. So when an investor shorts a certain share, the investor's broker borrows the shares from another client's account and sells them in the usual way. To close out the position, the investor must purchase the shares. The broker then replaces them in the account of the client from whom they were borrowed. The party with the short position must remit to the broker dividends and other income paid on the shares. The broker transfers these funds to the account of the client from whom the shares were borrowed. Occasionally, the broker runs out of places from which to borrow the shares. The investor is then short squeezed and has to close out the position immediately. A fee may be charged for borrowing shares. What is the difference between the forward price and the value of a forward contract? The forward price of an asset today is the price at which you would agree to buy or sell the asset at a future time. The value of a forward contract is zero when you first enter into it. As time passes, the underlying asset price changes and the value of the contract may become positive or negative. Suppose that you enter into a 6-month forward contract on a non-dividend paying stock when the stock price is $30 and the risk-free interest rate with continuous compounding is 5% per annum. What is the forward price? The forward price is then 30 times e to the 0.05 times 0.5, which is 30.76. So it's basically S0 e to the RT, okay, which is F0. So that's the usual formula in your book. So, okay, we can look at that formula one more time. Okay. This is the main formula in your book, basically. One of the first formulas that exist in your book. There it is, F0. Let's just zoom in a little bit. This is the formula, F0 equals to S0 e to the RT. As you can see, it's just an application, a simple application of this formula. That's what is being done in that question. Okay, and so we applied that formula that we saw in the book, as we can see, and we got the forward price over here. So then we have a stock index currently stands at 350. The risk-free interest rate is 4% per annum with continuous compounding, and the dividend yield on the index is 3% per annum. What should the future price for a 4-month contract be? Then the future price should be what? Should be 350 times e to the 4% minus 0.03 times 1/3 of a year, because it's a 4-month contract. So where did this formula come from? Okay, this formula is again taken from your book. Let's just, so it's S0 e to the R minus Q times T, that's equal to F0. That's basically it. But let's just look at that in your book. So there with a known yield, this is the formula that is being applied in that example, in that exercise. F0 is equal to S0 e to the R minus Q times T. That's the formula that's applied in that exercise in your book. F0 equal to S0 times e to the R minus Q times T. Q is the dividend that's being paid, R is the interest rate that is being paid. Okay, so the dividend yield is Q, R is the interest rate. So let's stop sharing. Okay. So that's what's applied over here. So the next question is asking you, what is asking you to do is explain carefully why the futures price of gold can be calculated from its spot price and other observable prices, whereas the futures price of copper cannot. And the answer to this is basically that gold is an investment asset. If the futures price is too high, investors will find it profitable to increase their holdings of gold and short futures contracts. If the futures price is too low, they will find it profitable to decrease their holdings of gold and go long in the futures market. Copper, on the other hand, is a consumption asset. If the futures price is too high, a strategy to buy copper and short futures contracts will work. However, because investors do not in general hold the asset, the strategy of selling copper and buying futures is not available to them. There is therefore an upper bound, but no lower bound. There is therefore an upper bound, but no lower bound to the futures price. So explain carefully. So this is the difference. So that's the difference between a consumption asset and an investment asset. As we can see, we can go back to the book and recall what is going on there. So we can stop sharing and go back to the book. And so here we have a situation which is basically so yeah. So for consumption commodities, what we have is basically this situation. We have the situation that, so let's just go through this one more time. So commodities that are consumption assets rather than investment assets usually provide no income, but can be subject to significant storage costs. We now review the arbitrage strategies used to determine futures prices from spot prices carefully. So suppose that instead of equation 5.11, where we have equality, we have inequality. So F0 is greater than S0 plus U to the RT. To take advantage of this opportunity, an arbitrager can implement the following strategy: borrow an amount S0 plus U at the risk-free rate and use it to purchase 1 unit of the commodity and to pay low storage costs. Short the futures contract on 1 unit of the commodity. If we regard the futures contract as a forward contract, so that there's no daily settlement, this strategy leads to the profit of F0 minus S0 plus U e to the RT at time T. There is no problem in implementing the strategy for any commodity. However, as arbitragers do so, there will be a tendency for S0 to increase and F0 to decrease until equation 5.13 is no longer true. We conclude that equation 5.13 cannot hold for any significant length of time. So this inequality will not hold for a significant length of time. If we suppose next that F0 is less than S0 plus U e to the RT, when the commodity is an investment asset, we can argue that many investors hold the commodity solely for investment. When they observe the inequality in equation 5.14, they will find it profitable to sell the commodity, save the storage costs, and invest the proceeds at the risk-free interest rate, and take a long position in a futures contract. Okay. The result is a riskless profit at maturity of S0 plus U e to the RT minus F0 relative to the position the investors would have been in if they had held the commodity. It follows that equation 5.14 cannot hold for long, because neither equation 5.13 nor 5.14 can hold for long. We can have equality. However, this is true for an investment asset. But what happens is that this argument cannot be used for a commodity that is a consumption asset rather than an investment asset. Individuals and companies who own a consumption commodity usually plan to use it in some way. They are reluctant to sell the commodity in the spot market and buy forward or futures contracts. And because forward and futures contracts cannot be used in a manufacturing process or consumed in some other way. There is therefore nothing to stop equation 5.14 from holding. And all we can assert for a consumption asset is that F0 is less than or equal to S0 plus U e to the RT. U is the storage costs, as we can see. So if storage costs are expressed as a proportion of the spot price, the equivalent result is that F0 is less than or equal to S0 e to the R plus U times T. So that's exactly what we have when we have a consumption asset. We have actually an upper bound to F0, or S0 e to the R plus U times T has only a lower bound. F0 is only a lower bound to that amount. So let's go back to chapter 5. Okay. Okay, so that would be the case for copper. For copper, we would have F0 is less than or equal to S0 plus U, S0 plus U e to the RT, or S0 e to the R plus U times T. So there is therefore an upper bound, but no lower bound. So there we go over here. Exactly, this is what's going on. If the futures price, copper is a consumption asset. If the futures price is too high, a strategy of buying copper and short futures works. However, because investors do not in general hold the asset, the strategy of sell copper and buy futures is not available to them. There is therefore an upper bound to F0, but no lower bound to the futures price. Okay, so there is an upper bound to F0, but there is no lower bound to F0, basically, which is what we just saw. Okay, the next question is asking to explain carefully the meaning of the terms convenience yield and cost of carry. What is the relationship between futures price, spot price, convenience yield, and cost of carry? So the convenience yield measures the extent to which there are benefits obtained from ownership of the physical asset that are not obtained by owners of long futures contracts. The cost of carry is the interest cost plus storage costs less the income earned. The futures price F0 and spot price S0 are related by F0 equal to S0 e to the C minus Y T, where C is the cost of carry, Y is the convenience yield, and T is the time to maturity of the futures contract. Okay, so okay. Okay. So convenience yield measures the extent to which there are benefits obtained from ownership of the physical asset. So that's it. And the cost of carry is the interest cost plus storage cost less the income earned. Okay. Then the futures price and the spot price for a consumption asset is equal to S0 e to the C minus Y, where C is the cost of carry, Y is the convenience yield, and T is the time to maturity of the futures contract. Okay. Explain why a foreign currency can be treated as an asset providing a known yield. So a foreign currency provides a known interest rate, but the interest is received in the foreign currency. So the value in the domestic currency of the income provided by the foreign currency is therefore known as a percentage of the value of the foreign currency. This means that the income has the properties of a known yield. Okay. So the value in the domestic currency of the income provided by the foreign currency is known as a percentage of the value of the foreign currency. So it's basically, so this is the same as the income having a known yield, that income having a known yield. If the futures price of a stock index, sorry, the question is asking, is the futures price of a stock index greater than or less than the expected future value of the index? Explain your answer. So the futures price of a stock index is always less than the expected future value of the index. This follows from section 5.14 and the fact that the index has positive systematic risk. For an alternative argument, let mu be the expected return required by investors on the index, so that the expected value of ST is equal to S0 e to the mu minus Q times T. Because mu is greater than R and F0 is equal to S0 e to the R minus Q times T, it follows that the expected value of ST is greater than F0. We have basically positive systematic risk. Let's just remember from our slides a little bit here. So yes, let's go back to the last slides. So we have basically the index has positive systematic risk. What it has is that K is greater than R. So what you have is that F0 is less than the expected value of ST. So for stock indices, we have positive systematic risk. So F0 is less than expected value of ST. So that's the case here. here we see it more. Yeah, so you have K or mu in that example, it's greater than R, so F0 is less than the expected value of ST. So we have positive systematic risk for stock indices. So we continue. Okay. So we see that the future price of a stock index is definitely less than the expected future value of the index, okay, for a stock index. So here we have a long problem. Let's look at that. So we have a 1 year long forward contract on a non-dividend paying stock. It's entered into when the stock price is $40 and the risk-free rate of interest is 5% per annum with continuous compounding. The question is, what are the forward price and the initial value of the forward contract? And then the question is, 6 months later, the price of the stock is $45 and the risk-free interest rate is still 5%. What are the forward price and the value of the forward contract? So again, so we begin by calculating the forward price and the initial value of the forward contract. So the forward price given by the usual equation will be $40 times e to the 0.05 times 1, which is 4205. So $40 times 0.05 times 1, which is 4205. Then 6 months later, the price of the stock is $45 and the risk-free interest rate is still 5%. So the question is, okay. So they're asking you, the price of the stock is at $45 and the risk-free interest rate is still 5%. The question is, what are the forward price and the value of the forward contract? So the delivery price K in the contract is now 4205, okay, which we calculated over here, okay. The value of the contract after 6 months is going to be K, I'm sorry, so S at that time, so $45, S at that time minus K, which is 4205, okay, discounted by e to the minus 0.05 times 0.5. So let's see where this formula comes from. So let's stop sharing here. Go back to our book. Okay. So this is going to over here. There we go. So basically the question that is being applied here is S minus K e to the minus RT. So that's equation 5.5 that is being applied after the end of the 6-month period. So we stop pausing. Let's go back. Okay, so then that's S0 at that time. So 6 months later, S0 is 45, K is 4205, what we found over here. Okay, and basically that is being discounted by e to the minus. So why is that? Why is K 4205? Because that is the delivery price in the contract, which is 4205. So then 4205 e to the minus 0.05 times 0.5 is going to give you 399, and that's the value of the forward contract. And what's the forward price? The forward price is going to be 45, which is S at that time, whatever S is at that time, times E to the, excuse me, E to the 0.05 times 0.5, which is $46.14. Okay. So the next question is asking you, it's telling you that the risk-free rate of interest is 7% per annum with continuous compounding, and the dividend yield on a stock index is 3.2% per annum. The current value of the index is 150. What is the 6-month futures price? Okay, so using equation 5.3, let's go back to equation 5.3. Okay. I mean, this is just a simple application of one of the formulas in your book. We can just see it real quick. So it's just an application of this particular formula. F0 is equal to S0 e to the R minus Q, where R is the interest rate and Q is the dividend yield expressed as compounded yearly. Okay. Okay, so basically it's 150 times e to the 0.07, so this is the risk-free rate, minus the dividend yield, which is 0.032, times 0.5, because it is a 6-month futures price that we're looking for, and that's 152.88. Okay. So let me stop sharing the screen. So this is just, so we have just been through the first 10 exercises in each of the chapters, and in preparation for our midterm. The midterm is next week, exactly. It's going to be sent to you at 5:30 p.m. on the day, and on November 1st, I believe it is. Let me just look at the schedule. So let's share the screen once again. So again, so your midterm is on November 1st, and the way it's going to be conducted is that it's going to be sent to you at 5:30 p.m. on that day. and you are supposed to, the midterm will be sent by email at 5:30 p.m. and you will have until 7:30 p.m. on that day, November 1st, to send back your answers by email. You cannot miss the midterm. I will need to be notified by 48 hours, in 48 hours, and you need, basically, you really don't want to miss the midterm, because you will then have a final which will be worth 90%. So, the midterm will be sent by email at 5:30 p.m. and your answers are due back to me at 7:30 p.m. on the same day. And as we can see, so this is the end of our exercise session, which is lecture number 7. And November 1st is the date of your midterm. Okay. So if you have any questions, you can just show up in my office hours and I will respond to that. I will respond to your questions. Also, if you cannot make the office hours, you can email me and I will make a special time for you in case you cannot make the office hours. But I need some days notice for that. Okay, so this is the end of lecture number 7 of STAT 761. Thank you.